Hi, this is your host, and today we're going to be talking about credit score myths. There are so many things that people believe about their credit score and how it is calculated that aren't actually true. So in this video, I'm going to go through some of those common misconceptions and clear them up for you. The first myth is that if you don't have any debt, then you won't have a credit score. This one is false. You can actually establish a credit history with just one account. So it could be a credit card, an auto loan, or even a single bill payment. By making on-time payments every single month, you can build a credit history over time. Another myth is that closing your old accounts will hurt your credit score. Closing an account won't hurt your credit score unless it's your only account. It may lower your overall limit, which can increase your credit utilization ratio. But closing an account doesn't automatically report to the credit agencies. So even if it did impact your credit utilization, that wouldn't affect your score until you received a statement from that account showing the updated information. As long as you have at least one active account open, you should be fine. But just be careful, because there is also a myth out there that says that the longer you've had your accounts open, the better it is for your score. That isn't necessarily true either. There may be an initial boost when you first get a credit card, because it shows that you've had that account for a period of time. But after that, the age of your account won't really impact your score anymore. The most important thing is that you use your accounts responsibly by paying them on time and in full each month. If you stop using them, they may end up hurting you more than helping you. Speaking of credit cards, it's also a myth that you need to pay off your credit card balance every single month. This isn't true. In fact, keeping a small balance in your credit card can actually help you build credit. As long as you're only using 9% of your available credit, you should be fine. Using too much of your available credit can result in a penalty APR, which means that your interest rate can increase significantly. But not using it at all can also have a negative impact on your score, since it shows no activity. So find a balance that works for you. Maybe you pay the balance down below 9% before the billing cycle ends, and then pay it off in full once the cycle closes. Or maybe you carry a very small balance from one billing cycle to the next. The most important thing is to make sure you're paying the bill on time every single month. And while we're on the topic of credit cards, let's talk about credit utilization ratios. A lot of people believe that you shouldn't use any of your available credit because that would hurt your score. But like we just talked about, that isn't actually true. The best way to think of your credit utilization ratio is to imagine it like a speedometer in your car. When you first get your driver's license, you might drive slowly and carefully, but over time you get more comfortable and start driving faster. As long as you stay under the speed limit, you should be safe. Credit utilization works the same way. Keeping your usage low at first can help you build credit, but eventually you want to start using some of your available credit to show lenders that you rate trustworthy and can handle a larger amount of debt. Just make sure you keep your usage under 30%. If you go over that limit, lenders may see that as risky behavior, and it could negatively impact your score. Another myth is that a secured credit card can't help you build credit. Secured cards require a security deposit, which is typically equal to your credit limit. So if you put down $500, you'll get a $500 credit limit. A lot of people believe that since you're essentially putting money toward your limit, it won't help you build credit. But that isn't true. Secured cards can absolutely help you build credit as long as you use them responsibly. And they are actually a great option for people who have limited or no credit history, because they help you establish a payment history. Plus, if you do happen to miss a payment, you won't have to worry about getting sent to collections because your security deposit will cover the cost. So secured cards can help you build credit without worrying about making mistakes along the way. But if you want to build credit quickly, then you may be tempted to apply for as many credit cards as possible. And that brings us to our next myth, which is that you can apply for as many credit cards as you want without hurting your score. Applying for new credit does temporarily lower your score because it shows lenders that you might be taking on more debt. Plus, when you apply for a card, a hard inquiry is run on your credit report, which can also lower your score. Getting too many hard inquiries in a short period of time will negatively impact your score. So if you're trying to build your credit, it's best to wait at least a few months between applications. But speaking of credit reports, it's also a myth that you can only get one free report per year. You actually get one free report from each major credit agency every single year. So that's 3 free reports every 12 months. Annual Credit Report.com is the only authorized website to provide free credit reports. So be wary of any other websites that claim to offer free reports, because they probably aren't legitimate. Next up is the myth that you can remove negative items from your credit report by disputing them. If you haven't made a mistake, you can't dispute it. Negative items that are accurate and legitimate can't be removed from your credit report just because you don't like them being there. However, if an item is incorrect, you can contact the credit bureau and ask them to investigate. You can also get help from a reputable credit repair company. We have a team of experts who know exactly what to look for and how to word your dispute letter. Our team has helped clients remove over $100 billion in negative items from their credit reports. And we can help you too. You've probably heard this one before, but having a cosigner can negatively impact your score. That isn't true. Having a cosigner can actually positively impact your score because it shows lenders that you're less risky, since the person co-signing your loan or credit card has a proven track record of on-time payments. They're essentially vouching for you and giving you credibility. So even if you've never had a credit card before, having someone with good credit co-sign for you can help you get approved for a great card that you would have never qualified for otherwise. But once you start building credit, you may notice that your score doesn't increase as fast as you thought it would. And that brings us to the next myth, which is that missing one payment will drop your score by 100 points. Missing one payment won't drop your score by 100 points, but it will hurt you in two ways. First, it'll hurt your payment history, which makes up 35% of your score. Late payments stay on your report for up to 7 years. Second, it'll hurt your credit utilization ratio, which makes up 30% of your score. If you miss a payment and your credit card company reports it to the credit bureaus, the negative information will stay on your report for up to 7 years. So, you could see a decrease in your score of anywhere from 100 to 200 points. Even one missed payment. But that doesn't mean that you should just stop trying to rebuild your credit. With our help, you can recover from a missed payment faster. We'll help you write a goodwill letter to your creditor asking them to forgive the late payment. Then we'll help you set up an affordable payoff plan so you can pay off the debt and move on. So there you have it, 9 myths about credit scores debunked. I hope this video was helpful. And if it was, please like it so more people see it. You can also subscribe to this channel for more financial tips. Thanks for watching, and I'll see you next time.